Welcome back to another episode of the Recession Resistant Real Estate Radio. I'm your host, Brandon Cobb, co-founder of HPG Capital. And today I've got my friend, Matt Four, on the show. He's a part-time real estate investor. He's based out of Nashville, so we both live in the same area. In his professional life, he spent over a decade in sales and sales leadership. He's had positions at some of the largest tech companies in the world. After he found real estate, Matt was able to achieve financial independence in 3 short years by the age of 32. I'm excited to jump into that journey today. He's invested in over 750 multifamily units. He's got various real estate debt. When he's not working, he likes to read, training for Ironman triathlon, something that I haven't done yet. So you got one up on me. And then convincing his brother that he is the favorite twin. Matt, welcome to the show.
Thanks for having me, Brandon. And I got to say, on record, I'm upset at you. I had you on the show and you were so generous and gave me some butter pecan Jack Daniel's snacks afterwards as a thank you for having you on the show. And they were so good and destroyed my diet that I put on the COVID-20 from just those. So,
did you really? The COVID-20?
They were
like
delicious.
The freshman 15 in college.
That's right. That's right. I thought I could have one and my willpower was not good enough to have one. I had the whole bag. So thank you.
I was trying to figure out a way to send you ice cream because you're podcast ice cream investors, but they have not figured out a way to get that into the mail yet. So I couldn't use that method, but I'm excited to talk to you with today. So tell us a little bit about, what's your focus right now? What are you working on today? And then maybe give us a little bit of history, your story, and how you got there.
Yeah, sure. So I'll give away of the story of how I got into real estate. So I've spent a decade and a half in sales and sales leadership positions at some of the largest technology companies in the world. And how I got involved in real estate is in 2016, we landed a massive net new $10 million deal. And I saw the amount of commission check I was going to get on that deal. And my eyes lit up. And I started asking everybody, like, what should I do with this money? I heard everything from crypto to stocks to bonds. And then I had a friend at the time who said, you should buy real estate. Get some cash flow, tax benefits, appreciation. With the amount of money I was about to receive, I could have gone and bought 3 or 4 properties just straight up in cash. And then I got the fateful call the week of Christmas a couple of years ago that said, from my VP at the time, that said, you're not going to get that commission check. You're going to get 2 cents on the dollar. And I said, wait a second, how did we get here? What determining factors do we have? And he said, I remember the question. He was like, Matt, haven't you made enough money this year? And it was at that point that I realized, like, hey, I need to take my own financial future in my own hands if I wanted to achieve the goals that I have, give back to the causes that I care about. So started my real estate journey then, scaled it up into 10 single families, quickly moved into commercial real estate, multifamily, self-storage, some debt, and car washes. But that's my story. So that's how I got here.
Yeah, that's really powerful. Nothing's more motivating than having this amazing carrot at the end of the road that you've been pushing really hard for. At the end of the day, you can be as loyal as you want, work as many hours, and you really have no leverage when it comes to working with your family. But it sounds like you took that and turned it into a huge positive. I think it's really easy to sit and talk about or dwell on how negative a situation can be, but you took action. You actually took it, probably had a little bit of anger towards that company, harnessed it and manifested it in action. And it sounds like you went and did multiple types of real estate deals. So I guess walk us through the beginning journey. You said like self-storage. I think you said some single family in there. How did you find what you were ultimately working on today? Because it sounds like you were sort of all over the place. Did you eventually like niche down, or are you still, diversified?
So I'm still diversified in a sense. I'll take you back. So when that moment happened, look, I want to clarify 2 things. One, it was a company I previously worked for, not a company I work for today. And 2, I think you're right. Like pain can be a motivator, and it would have been easy to kind of sulk in those wounds. But I knew that at this point, it kind of kicked me in gear to take my financial future in my own hands. So I quickly turned around and bought a turnkey townhome right around the corner from where I lived, started learning about BRRRRs and fix and flips and things like that, did a couple of those. And then I got to the point where I had 10 single families and I fell out of Fannie and Freddie's checkbox. After 10 single family units, Fannie and Freddie won't guarantee any more loans. You have to either go find a commercial portfolio loan, or you have to find a guarantor that will keep it in-house, a loan that will keep it in-house. So that's when I was looking around, like, what do I do? And that's where I found real estate notes, multifamily, some syndications and things like that. So where am I at today? What does my portfolio look like? I primarily focus on 3 different markets right now. One is multifamily. I believe multifamily should be the foundation of anyone's investment class or their investment portfolio in a real estate segment. The second is debt. So I loan out private money to fix and flip and hard money loans and things like that. And then the third I lump together, it's more businesses that operate with real estate as a foundation of what they do. So that's really self-storage and car washes. Happy to talk through any of one of those asset classes, but that's kind of where I'm focused today.
I want to get to the method that you've got for evaluating deals, because a lot of these types of, commercial deals can be fairly complex, and it kind of scares a lot of people away from ever even getting started, which is sad because it is a great alternative investment class. Like you said, I think multifamily is fantastic. I invest my personal capital into other people's multifamily deals because I love the cash flow. I like the insulation, and I like the depreciation that I've been getting from it. But before we jump into that, I also like to cross pollinate skills from certain industries into real estate. A big part of my life was taking what I learned in sales and applying it to real estate from my medical sales career. And I mean, that really catapulted me. I know that you are an Ironman triathlete. I'd like to hear how your Ironman training and competitions have really fueled and served you in your real estate business.
Yeah, sure. So to level set, an Ironman competition is a 2.4 mile swim, 112-mile bike, a 26.2 mile run. Yes, it's all in a single day. Yes, it's all in a single event. I have no idea why I do it other than I'm a glutton for punishment. No, I always grew up playing athletics, and Ironman is a sport where you just have to show up consistently and work at it every single day. I like to say, like LeBron James, no disrespect, but he's 6'8", 250 pounds of solid muscle, can jump out of a gym. He's got a heck of a work ethic and treats his body well. But that dude was born to be an athlete. At an Ironman, when you show up to that starting line, everybody has put in the work to get to that point. So I have mad respect for anybody that can even take on the audacity of showing up at the starting line. But what I've learned through Ironman more than anything is my 4 steps to achieve anything in life. And it's really clarity, consistency, coaching, and then compounding. So you have to be clear on what your goal is and where you're headed and just start moving in that direction. You have to pick some sort of consistent action that you can do every single day. And here's where I want to say, give yourself some grace on what that action is. It doesn't need to be the right action. It just has to be an action that takes you towards your goal and you can commit to every single day. That third part is really the coaching. Now it's about doing the right activities and getting the feedback on how your performance is growing and things like that. And then the last is compounding. And so when I look at financial independence, financial movement, real estate investing, and things like that, it's really clarity. Like, where do I want to be? Do I want to be a developer? Do I want to be a passive investor? Do I want to put deals together? What is your unique skill set that you can march towards? What is the one activity that you can consistently do every day? How do I get a group of like-minded individuals around me that have already been on this journey so they can coach me along the way? And then compounding is just trusting that those actions will lead to the right thing. You just have to give it enough time.
Yeah, being around the right group is so important, right? Masterminds, coaching. A lot of people don't think of athletics like that, right? Unless you were, back in the high school days when you'd get on the team and you'd actually have to have a coach to be able to push you. But I mean, it's huge. I ran a marathon, and I didn't do any training or anything. I kind of just got up one day and said I was going to do it. And I did it. Believe me, I did. It took me 5.5 hours, but man, my knees were hurting, and it really killed my motivation to be able to do an Ironman, because I'm like, oh my God, I got to do that plus swim 3 miles and bike 100. So holy cow. But taking consistent action, whether it's in athletics or real estate, is extremely important, because you don't have to have everything figured out in the beginning. Some kind of action is better than nothing at all, because more than likely your efforts are going to pivot and mold into what you need to be doing for that.
Yeah. Two things I want to say there. Action breeds momentum and breeds emotion. So a lot of times when I talk to folks, they're like, I don't know what I'm passionate about. I don't know what I want to do. And I'm like, you've got to start doing something before you become passionate about it. So I would encourage people, like, you have to get going before that passion and that drive and the skill set really develops. The second thing I would say about coaching is you're absolutely right. I mean, Michael Jordan had a coach. Tiger Woods has a golf coach.
Mm-hmm.
Why do you think that you don't need a coach for whatever you're doing in your daily life? So I love that you talked about that coaching aspect of it.
And it's funny, there is so much value that you get when you accomplish something really physically challenging that somehow pushes you mentally to crush those like mental barriers. Like I know that when I ended up running my marathon, there were a few things in business that I went out and I just absolutely crushed. Did you find yourself doing something similar? Like what did that look like for you?
100%. I'm I enjoy athletics. I love fitness. So I want everybody to take this with a grain of salt. But I think doing something physical and getting into fitness, getting into the gym, even if it's 10 minutes a day,
Mhm.
will change your perspective mentally because you're working towards something and it increases your blood flow and things like that.
Mhm.
But when you see the physical difference in your body, it's one of the few things that you can do out there that you physically see a difference in yourself, then that gives you the self-confidence for the next task that you're about to endure. So 100%.
Yeah, your emotions lead to your decision making. Your decision making leads to your outcomes. And if your emotions about yourself or a lack of confidence, that's going to bleed over into your actual outcomes that you get. So I love it. Big proponent of athletics and mixing that with business. Let's get into how you evaluate deal flow. You're involved in over 750 multifamily units, various real estate debts. I love the diversification. You've got a huge mix of cash flow with your current portfolio. Tell us a little bit about your method. I think you call it the FORE method for understanding any investments and the things that you might look for if you were a newer investor and you knew what you would today. Like, what would be some of the things that you would do differently today that you did back then?
Yeah, so I think first and foremost, this addresses the clarity piece of it. So as I started getting involved in investing in financial independence, people would ask me about deals and they're like, "Hey Brandon, should I invest in this deal? Should I invest in that one?" And I first ask them, "Well, what is this deal? Like describe it to me." And what I found is like people knew the numbers that the spreadsheet told them on the deal PPM, but they couldn't tell me anything else about it. So the FORE method is really meant to help you understand any investment out there. And the first one of the four is financial liquidity. So liquidity is how fast you can sell an asset and get the market rate, not at a distressed value, not like trying to sell some FTT tokens here at the end of 2022 or some sort of crypto token, but how fast can you sell an asset at its market rate? And I want to clarify, like something being illiquid sometimes is a good thing because our emotions get in the way of finance, and not being able to sell something so quickly is actually a good thing.
Yeah.
So first and foremost, you need to understand what is your liquidity. The second thing you need to understand is your ownership. So when I think about ownership, there's really two positions. There's the debt position and then there's the equity position. I'm not here to advocate one's better than the other. You're going to have to make that decision, but you need to know when I'm investing in this, am I investing because I am the debt holder or I'm the paper holder? Or am I investing in this because I'm going to be on the equity side of them? The R in the FORE method is the returns. And when I think about the returns, I'm thinking when, how frequent, and how much. And when we think about returns, there's two different types of returns you need to decipher between. There's return of capital, and then there's return on your capital. Your first goal, in my opinion, on any investment strategy is capital preservation. You need to understand how am I going to get a return of my capital before you ever ask, how can I get a return on my capital? And then the last and by far the most important is effort. And this really comes down to, are you going to be an active investor or a passive investor? You're absolutely going to get better returns being an active investor, but are you going to be more intentional with your family, with your friends, with your hobbies, with your career by being a passive investor instead? And so when you're deciding between an active and a passive investor, you need to think, what's my mental activity in this? What's my mental state as I invest in this? And then am I going to have to be physical in this asset? Am I going to be doing the management, swinging the hammers, going to property sites and things like that? So the FORE method, again, is like financial liquidity. What is the liquidity of this asset? The ownership, am I the debt or the equity? The returns, how am I going to get paid? When am I going to get paid? And how much am I going to get paid? And then last and most important is, what is the level of effort needed by me to make this asset successful or this investment successful?
Yeah, I can't harp on how important that last part is because you got to get very clear about what you want. Surprisingly, not many people, investor, passive investor, active investor, are very clear on what exactly is they want in the long term. And that's what's going to dictate your decisions that you need to make today and the groundwork you need to lay out. There's two letters in there I want to dig a little deeper on. One is the ownership piece, because a lot of people might not understand the benefits and disadvantages and advantages between, being an equity investor and being a debt investor. And then I want to talk about the R part of that. So maybe give some people some examples of maybe and maybe your personal decisions on some equity investments that you've decided to take part in, maybe what the advantages are and disadvantages, and then some of your debt investments and vice versa.
Yeah. So on the ownership stack, I'm trying to bleed out my portfolio to have a good mix of debt and equity. And debt is more secure or more senior in the capital stack than an equity piece, which is good in the case of a bad downturn, which is bad in the case of a tremendous upside, because you're usually limited on the amount of return you're going to get. So that's why I'm looking at buying distressed mortgages out there. I own a couple of those in my portfolio. I'm looking at fix and flip funds. So if Brandon wants to go fix and flip a home, I will provide them a set return, set interest rate on my capital, but I don't appreciate the upside that he gets from flipping that home. But on the equity piece, when we were going in a lower interest rate environment, that money has to go somewhere, and it usually flows into assets such as real estate. So being in the part of the equity stack, you're going to be junior in the capital stack, but you're going to see the appreciation of that. So I think a good balance of both helps you protect on the downside while also capturing upside returns. So I'll stop there. Any thoughts there or questions?
No, it's 100%. One of the things I look for in, basically, you want to ask yourself, all right, how much of a buffer, when I'm an equity investor in something, one of the questions I want to ask myself is, what kind of buffer can the market hit before my principal starts to be affected? And what kind of buffer do you have? How much cash reserves are sitting in this apartment complex? How much is it cash flowing? What would the vacancy rate have to be before we start entering a negative cash flow situation and, my principal starts to be affected? Because I think a lot of people don't understand that because you're an LP and you're subordinate to that bank debt, in the worst case scenario, you could potentially lose all your investment if that value of the asset drops below a certain point. So it's very important to understand what are the factors that are contributing to the forced appreciation of that asset. And if the sponsor is just relying on inflation and, crazy speculation on increasing rents like that, those are some of the flags that I look for. And then on the debt piece, the stuff that I look for, personally debt on is like, would I be okay with inheriting this asset? And if I can't answer a yes question to that, I don't do it. I love your strategy of the hard money loans on single family, because that was the world I'm used to. I understand that very well. I know exactly how to calculate ARV. I know exactly what the budgets are. I used to flip a bunch of properties. So I'm extremely comfortable lending on that asset because I can potentially take it over one day, worst case scenario. Do you have any nuances there? Is there anything that you want to add?
No, I think the only nuance I would throw in there is, so in the investments that we offer, we typically offer a preferred share, which is kind of like a debt position. It's a locked set of returns, and you are senior in the capital stack to an equity B share owner. And I am starting to shift. Well, for two things I would say. One is, if you're trying to run to financial independence fast, usually a debt position is a little bit better because there's generally more cash flow coming in on the front end, and you're not banking on the appreciation on the back end. I will start that and say all deals are different, right? And then the second thing is, as we move into choppy waters of 2023 and 2024, I'm starting to allocate more of my investment portfolio to those preferred shares, because I don't want to bank on the fact that my IRR is dependent on the fact that we're going to sell this for more than what we purchased it for.
Mm-hmm. You want to go ahead and get your money up front as opposed
That's right.
to being on the back end. Yeah,
that's
really,
right.
Really smart. So what are, before I get into that, tell us a little bit about your journey. 3 years to financial independence. That is incredible. I mean, that's a huge success story. I mean, I think that puts you in the top % of the people who, quit their job and do that. I mean, that's a very short time frame. Walk us through that journey. How'd you do it?
Yeah. So I want to put an asterisk on this and say, when I say financially independent, I'm not flying first class Air Dubai on some fantastic vacation, all expenses paid for, right? What I mean by financial independence is that my food and my shelter in perpetuity are paid for. I never really have to worry about where my next meal is coming from. And Brandon, what I will tell you is that in 2020, that had a drastic difference on how I handled March of 2020 when my equity portfolio was down 40%. I was worried about my real estate and all those sorts of things.
Mhm.
Knowing that I had that consistent, predictable cash flow that would pay for my housing and my food gave me a lot of breathing room. It's also helped me be more intentional with my life. I think that all of us are tied to particular jobs or careers or responsibilities that require us to take time away from our families, our hobbies, or things that we're passionate about because they are pulling us there from a financial need standpoint. I need to do this because I can't lose out on the revenue that will come in from this, from that sale, or I need this job. So that changed tremendously how I approached me as a leader in my career and what I was able to do with my life and the intentionality. How I was able to do that was through just sweat equity on the first 3 years. So when I first got involved in real estate, I mentioned that it was a turnkey. That I still own that asset today. I will never sell that asset because it was the first asset that I invested in, and that was the start of my journey. But it also made me realize, okay, that's not the greatest return. If I actually go out there and grind a little bit and hustle a little bit and try to find some of these undervalued deals and do some of these BRRRR strategies with take out the equity and go do it again, that I was able to scale my portfolio so much quicker because I have one deal that I bought for 80, put 20 into it, and I had to pay $10,000 in hard money lending. So I'm in it for 110. I was able to cash out 115 of it. So I got paid $5,000 to own that asset and go do it again. So the returns on that are only like $250 a month, but that's an infinite return because I have $0 in that deal. So that was kind of how I was able to scale my portfolio quickly to be financially independent. That allowed me to go pursue other things in life.
Sounds like you were able to identify those deals where you're able to pull out the money that you had in it and just wash, rinse, repeat. And it sounds
That's
like you
right.
even made some money on the refinance, which if you're receiving money in the form of debt, guess what? You don't pay taxes on that. That's why it's
That's right.
hugely beneficial to identify those deals where if you can start making some money on the refi, it's tax-free, baby. Bring
That's
it
right.
on, load it up. So
That's right.
what types of asset classes have you been focused primarily on investing in? I know you named a few in the very beginning. And then how has the economic environment changed or impacted your thesis?
Yeah. So let's take that second one first. So how's the economic climate kind of changed our thesis? What I saw in 2019 to let's just call it 2022, since that's the time period we're recording this, is cap rate suppression on lower class assets. So what I mean is a typical C class asset, I believe, should trade in the 8 to 10% range, depending on your market from a cap rate perspective. What I started to see in 2020, 2021, 2022 is those C class assets trading at a 5.5 cap. And then people were planning on doing a value add to them to raise rents, renovate the properties, and things like that. Assuming that their cap rate would stay the same, they would go sell it in 3 or 4 years. Well, what I believe is that as money becomes more constrained and as liquidity dries out of the system, those C class assets have a lot more elasticity in them, meaning a 5 cap C class asset trading now at a 10 cap is a huge cap rate reversion back to the mean. So
Mhm.
what we started doing in 2021 and what I focus on is really class A assets. Class A assets are usually the brand new buildings that you see downtown that in a good environment typically are trading for 4.5, 5%, 5 cap rate are probably now trading for, I don't know, 3.5 to 4. So the reversion back to the mean, if it reverts, is not as elastic. I'm only going to revert back a point versus a 5 point in a class C asset. So I've started moving more of my money into class A assets, knowing that yes, we are targeting the higher end of the market. And yes, typically people trade down in economic times, but the reversion back to the mean is less, thus protecting our capital preservation that I first mentioned. Do you want to stop there or we can talk through different asset classes?
No, cap rate stability. I mean, that's you've harped on it right there. You want to make a more defensive approach as we move into this potential what everyone's calling a recession. But yeah, so move on to the different things that you had in mind.
Yep. So multifamily will always be tried and true asset class in my portfolio. I just mentioned what we're doing in multifamily to kind of adjust as the economic climate changes. But the other asset classes that I'm really interested in right now are, I mean, I'll always be interested in debt because I think debt serves a function of your portfolio. But businesses that operate like businesses and are evaluated as businesses that ultimately have real estate as the backbone. So I mentioned car washes at the beginning of it. Car washes are, you need real estate, you need buildings, equipments, and things like that, that, by the way, depreciates on a different schedule than commercial real estate. So most commercial real estate depreciates over a 39-year cycle because car washes are business expenses, business equipment. They depreciate on a shorter time schedule, I think 15 years. Don't quote me on that. So we're really focused on that asset class right now because we can depreciate faster. We still get a lot of the great returns that we see in real estate. And the ultimate goal is that car washes are a very fragmented industry right now. It's kind of like a mobile home parks. Lots of mom and pops out there running them. If we can buy a portfolio of these and roll it up as one big brand or one big portfolio, we believe that we will get a better exit rate, a better exit multiple than when we first acquired the asset. So the goal really is find these undervalued car washes that are run by mom and pops, take them under our umbrella, renovate them, put some standard processes and procedures in place, and later down the line, roll it up as one big package or one big brand.
You're taking the fragmented, piecing them together, and realizing that the sum is a lot more valuable than all the individual pieces added up together.
That's right. That's right.
Love it. And so with this, and what I want to bring the R of the FOR method into this. A lot of people focus on return on capital. And I think the crypto space is perfect for this because I compare the crypto space to the tech stocks back in the late 1990s. Everybody was starting an internet company. If you had a .com behind your name, like boom, people were investing in it. And there was no intrinsic value at all. And we all know how that ended. It was the internet that was really the backbone and focus on investing in the internet. Now it's, you got the blockchain, but very few people invest in crypto, in my opinion, and understand the blockchain. It's more or less, they're just trying to figure out which cryptocurrency is going to make them the biggest thing. And so there was a very, very heavy focus on return on capital, but all the greats, and you do this as well, focus on return of capital. In other words, capital preservation. Talk about those two distinctions a little bit and how your current portfolio plays into that.
Yeah. So I think your summary there was spot on. The crypto industry. So I work in technology and I understand blockchain, and I think it's a very, very valuable, underrated technology. And NFTs are part of blockchain. But when we think NFTs, all we're thinking is fancy art. No, an NFT is an then smart contract. If this happens, then that happens. And when that starts to get applied in the mainstream, whether it's real estate, the way record producers produce albums, or the way contracts are written by attorneys, it's going to be a phenomenal technology. The problem is with any new technology, we have to go figure out how and when we can use this technology, and then throw a little bit of regulation around it just so that everybody plays by the same rules. The problem, crypto people don't want to play by rules. They want to be deregulated. And to me, that I don't think that's one, scalable, and two, will end up well, as we're now seeing with the FTX environment. Doesn't mean that I don't believe crypto has a place in portfolios and that it's a good asset class for specific reasons, but we've got to put some rules around it and put some guardrails so that people can see it. So how that really plays into my portfolio, I'm typically like a 25% debt person, 75% equity. And what I mean by that is usually about 25% of my overall portfolio, I try to put into some sort of debt structured instruments, whether it's a preferred return and not actual debt, it just sits senior to the capital stack, or it's out there buying distressed notes from borrowers and trying to get them on a better payment plan. That's roughly how I look at my portfolio, because again, I like that stable, predictable cash flow coming into my environment. And if, to your point earlier, somebody doesn't pay on that or completely defaults on the debt instrument, then I can go acquire the asset at pennies on the dollar, and I'm happy to own that asset either.
Yeah, this has been some great stuff. If people want to learn more about what you do, learn more about you, connect with you, how do they go about getting in touch with you?
Sure. So, couple things. One, I have a podcast that we referenced earlier called Ice Cream with Investors. We bring on folks like your gracious hosts here to talk about all the different asset classes within real estate, in order to tease out kind of their best practices. So, Ice Cream with Investors is on every podcast app. The second is LinkedIn. You'll find me readily available there. I'm Matt Four, based out of Nashville, Tennessee. You'll see my ugly face up there. Or if you just want to email me, you can email me at matt@nextlevelincome.com, and I'll get back in touch with you.
Rock on. Check out Ice Cream with Investors. It's a fantastic show. You're not going to be disappointed. Email Matt, check his stuff out, and we'll see you guys next time. Matt, I appreciate you having you on the show today. This has been fun.
Yeah. Thanks for having me on, Brandon.